Well, good afternoon, everybody. Thank you so much for joining us today. We're just 1 minute over 12, so we'll kick it off and get started. Very excited to partner with Avisa Wealth Management and share these highly educational retirement webinars with our Connexus members and Thrive clients. So I am Amanda McFarland, the Director for Small Business and Retail for our rural markets. I've been with Connexus for just over 16 years in a variety of different roles. I've had the opportunity to work with our members for the majority of my career and very much looking forward to our call today. With that, I would like to introduce our presenter for the afternoon, Doug Carroll. Doug is the tax and estate specialist for Avisa Wealth, a wealth management partner to credit unions across Canada. He previously ran an estate planning law practice and was an advanced case consultant with a life insurer and a mutual fund provider. Doug also holds a business degree and a Master of Law specializing in tax and is qualified as a certified financial planner and a trust and estate practitioner. And he's been doing this for 25 plus years now, supporting our financial advisors from written articles to individual case consultations and, of course, webcasts like we're doing today. So our webinar will be recorded. I'm looking very forward to the discussion. So I will now let Doug kick us off.
Okay, thanks, Amanda. The music was playing while you were speaking. By the way, you had your own score going on as you were speaking. So I think it stopped now. I am going to push up my screen so that we have the content up there. And then I'm just going to move things around a little bit and make sure that you can see my my PowerPoint screen, because I can see you right now. And I'll get into the topic. So the topic here today is retirement decumulation, and as a term, people as I've been using this term, not just me, but as this term has been used over recent years, a lot of people say, I'm not familiar with decumulation. I know what accumulation is, but I think that as we have a continuing aging population and more media scrutiny or exposure of what happens on the drawdown phase of people's retirement income, then we're going to see this word more often. And obviously, people have worked and retired for centuries, but as our population and demographics go, we are seeing a very large proportion of the population now heading into retirement. And so this is a discussion topic which should be on the mind of anyone who is accumulating money in their retirement funds, that eventually they will be drawing these things down. But as I say, because of the larger and enlarged part of the population that's continuing to move into this phase, we're going to see more of this. So I'm going to take you through the topics. I'll just bring these up here so you can see them. As we did on the previous sessions, if you joined us on the previous sessions, we have about 10 topics. I may have an odd extra slide that's got another visual on it or something that reinforces a point. But otherwise, this is the number of topics that I'm going to take you through. It is the back end, not a technical term, the back end of the retirement accumulation to look at the decumulation. We had a session, our earliest session, on RSPs as the core program for tax sheltered individual savings towards retirement as our starting point. And then the next topic we did was on the coordination of RSPs and tax-free savings accounts. And then now we're talking about the decumulation side of things. It's not to say that the only place that you can accumulate towards your later years is in an RSP. I went through that in each of those previous sessions, that there's lots of places that you can accumulate your wealth and then eventually draw it down. But the core place tends to be individual RSP, or if you have a registered pension plan that you're a member of in your workplace, then that will be some part, if not the major part, of your retirement income. And then these other things can be wrapped around it. So I'm going to take you through this, and if you've got questions, you can pop them into the Q&A box. If there's something really critical, then I'm sure that Amanda will wave me down, and we'll deal with that. But generally what we tend to do is take the questions at the end. I'll go through this in about 40-45 minutes here, and that'll leave us maybe about 5 to 10 minutes at the end to deal with the questions that come up. And again, Amanda will keep an eye on that, and we'll discuss those. So I'm starting with this big picture of things. If you are familiar with I don't know if you call it a fable, but the blind men in a cave or in a dark cave who come across something, and they're trying to figure out what it is. And there's 6 of these blind men who then are touching this thing, and each of them is touching a different part of it, and thinks it's something different. So the one who happens to be touching the pointy bit at the front thinks it's a spear, and the one next to him thinks it's a snake, and the one who's off to the side thinks it's a wall. So you go through the different components, the different parts of what each of them is experiencing. And this is part of of course it's an elephant, and the elephant in the room when we talk about our finances is being committed and behaviorally in a position where we've accumulated the money, but then that tough point where you say, okay, now it's time to draw this down. Do I have enough? Have I done what I need to do, and how am I going to work from here? And when we look at this from a retirement perspective, quite often the time at which people are retiring is the when. That's the main question that people think about in the background, if not consciously in the foreground. When am I going to retire? As in, what age will I be, or may I be before I retire? And how long do I expect I'm going to have to provide for myself out there into the future? But then when you look at other perspectives of what retirement means, then there's other questions that you might look at, as in, what do you have? Where do you have it? And that's a lot of what I'm going to go through here. Who is part of your retirement? Is it just you? Is it you and spouse? Is it other dependents or family members, whether or not they're dependent? Do you want to leave something behind in your estate? And even if you don't want to, will you? And what are the implications of doing that? And I'm not going to get into heavy detail on the estate aspect of things. We can do a session later on about estate matters directly. Where are you going to spend your retirement, as in the geographic location that you're going to be in, and how are you going to surround yourself? And that's not to say that you're going to travel to the other side of the world, but are you going to remain where you are right now, or are you going to intentionally move? And it's going to happen once, twice, or a number of times as you go through those later years. The why is perhaps the one that gets missed out entirely. It's that need for having some purpose in your life. And once, for a lot of people, having worked for a very long time and being very connected to their workplace, their purpose is very much connected with their work activity, with the skills they have, with the credentials that they have, with the people with whom they have spent years and decades. And moving away from that kind of an environment, what is your purpose at that point? So how do you go about reinforcing your mental state in those years when you are no longer defined by where you are working, what you are working with, who are you working for and with, but what's your purpose in your life more generally, without necessarily being a worker who is earning income? How are you living in your life? And then the last thing, of course, is the decumulation plan itself. So I'm going to take you through some of the components of your retirement income. And this is now getting into getting away from that kind of high level metaphoric of the elephant in the room, and looking directly at the places where you will draw down your retirement income and where they're going to come from. And I'm starting with public pensions. For those who are very near to retirement, you probably have a pretty good idea of what the plans are. For those who are a little bit more distant, then you may not see the breakdown among the main types of public pension support that we have. and you may not know the principles behind them, let alone the numbers. So we'll look here at the numbers, the structure of the main public programs that we have available to us, the Canada Pension Plan and Old Age Security, and then I'll show you the high-level numbers that are associated with them. So the Canada Pension Plan is it's an insurance plan where during the course of our working years where you have working income, then you are required in your workplace to then pay premiums into the Canada Pension Plan that then effectively fund or create credits for your later retirement years when you're going to draw that money down. And it truly is an insurance-based plan. It's based on insurance principles. There are actuaries who have contributed to the structure of the plan overall and continue to be employed by the Canada Pension Plan. It is a user pay type system where we pay the premiums during our working years so that we can fund our later years. It does not go into government revenues at all. It is effectively owned by those who contribute into it. In addition to the retirement pension, there are other components of it. Disability pension, if you become disabled while you're a worker and cannot contribute, then you, depending on how long you've contributed, you will qualify, and depends on how much you get will be related to the length of time that you have contributed. You also have an additional support to a surviving spouse or common law partner of someone who maybe dies before taking the pension. You also have family members who might be dependents who will get some kind of support, minor children particularly, if someone becomes disabled or dies as a CPP contributor. And then there is a fairly small death benefit that comes about. So that's the Canada Pension Plan. This year in 2024, this is the figures for both the Canada Pension Plan and the Old Age Security, and I'll talk specifically about the Old Age Security in just a second. They are indexed from year to year. The maximum amount that you can get on the Canada Pension Plan at the quote normal retirement age, and I say that very specifically as when I say that, I'm not being facetious about it. It's referred to as the normal retirement age. So it is the figure that is used when it is expected that most people will take their retirement pension at age 65. If you have been a regular contributor into the CPP over the course of the years when you first could contribute to it, which is age 18, through until to age 65, and there are some years that you get credit for because you may have been out of the workforce, or you might have been in education. You might not have been working. So some of those years are not charged against you in terms of the spread from 18 to 65. But if you've been regularly working, then your maximum credits that you would allow for would be to receive this figure here, $16,375. Now, if you take the Canada Pension Plan early, you can take it as early as age 60, and you can delay it to as late as age 70. If you take it at age 60, for every month prior to the point at which you turn 65, if you take it early, then you take a 0.6% per month reduction in the amount that you will receive. So you take it at age 60, you will get $10,480, which is 64% of the target figure at 65. And if you delay until age 70, then you get a 0.7% premium for having delayed until you reach that later age. You don't have to wait all the way till 70. You don't have to take it all the way back at 60, but per month basis on the downside, 0.6% of a reduction and a 0.7% premium on the upside that you get. Now, I'm going to come back to that about when to take, not to tell you when to take, but the considerations in when to take and the implications of taking early or late, and your life expectancy that might be involved. So the Canada Pension Plan is based on you as a worker, your ability to contribute into it and the amount that you are required to contribute in, whereas old age security is a payment out of general government revenues to people who have at least reached age 65 and have been a Canadian resident for 40 years. You can delay taking the old age security out to as far as age 70, similar to the Canada Pension Plan. You can't take it earlier than 65, though, with the old age security. And the premium for the old age security for each month that you delay is 0.6% per month rather than the 0.7 that applies on the Canada Pension Plan. So old age security has nothing to do with whether you have worked or not. It is based on your residency. Again, you get the full amount, 85.60 as it stands right now. It's indexed on a year-to-year basis. If you were to delay that until you reach all the way out to age 70, then the figure you would get would be 11,128. In all cases, these figures are indexed from year to year. This is where they stand right now. Canada Pension Plan is indexed annually. The old age security is indexed each quarter. Based on an annualized figure, you get an increase each quarter with the old age security. Now, in addition to the CPP and the OAS, there's also something called the Guaranteed Income Supplement. It's actually a program or a connected program with old age security. And it's basically intended that if you are in a low income position, then you're kept from falling further into a poverty situation. And so it's not something that is extremely large relative to the Canada Pension Plan and the old age security. The core programs are the CPP and the OAS, but obviously critically important, the Guaranteed Income Supplement, or GIS, keeps people from falling into a difficult financial situation if people are low income. There's also a couple of other related programs, Spouse's Allowance and Allowance for the Survivor, both of which are for lower income, where you have a spouse of someone either who is a survivor of a deceased person who is entitled to the public pension, or someone who is getting the public pension, that again adds income into the household here. But the two core programs that we're generally looking at is the Canada Pension Plan and old age security as public pensions. Now, on this whole thing about taking early or late, I know that quite often people say, well, I want to take it as soon as I can because I don't want it to go away. The fact of it is with the Canada Pension Plan, it is well funded to the point where certainly anybody who's on here right now, for our lives, for our working lives, it is going to continue to be there for us until those long later years. But still, people might think in terms of, well, I don't think I'm going to live long enough to get my full benefit out of waiting to take the Canada Pension Plan until 65, or even to push it out to age 70 and get all those premiums. I want to take it when I can get it. And what this then brings up for me is this notion of the marshmallow effect. And what this is back in 1970, a psychologist, you'll recall this, it wasn't just marshmallows, but it was a psychologist who you might be familiar with as well, Walter Mischel, who set up this this study with young children under 10 in the kindergarten or so age range, where they had them sit down and put a couple of marshmallows in front of them and said, or put one in front of them and said, we're going to go out of the room, and if we come back and the marshmallow is still there, you'll get the second one. And he did a follow-up. Book, which was this one here in 2014, where the first study, and it's been replicated in all sorts of ways, showed that that there is a challenge associated with having this thing in front of you. Could you defer? Could you delay the gratification involved with the potential for having one marshmallow to wait for the second one? And there are a lot of psychological tests that have run off of that. What Mischel did in 2014 is he reported on the follow-up from a lot of those children who were involved in that study, that they not only do they distinguish the characteristics of them in terms of their ability to delay the gratification from the marshmallows, but it actually spoke to it statistically spoke to how a number of those children were in their lives and the successes that they had or the challenges that they faced. It showed that, in fact, their ability to delay the gratification was something that affected how they lived their lives and the pressures that they felt. The other thing is the idea of delaying gratification. It is something that can be taught and can be learned. The self-control, as I've got showing here. Why I go into this is because overall, statistically, we as a species tend to underestimate our own life expectancy. And also, though we think we're good at finances, we tend not to be really good at projecting out numbers over the course of quite a number of years, maybe from now until next year, but now until 5 years from now or a couple of decades from now, it becomes very difficult for us to be able to digest that and to understand it. So I think it's really important to understand the factual part of life expectancy. If you have an actual life-limiting condition, then that's something which is going to be a consideration on the decisions you make about when to begin your public pensions and make other decisions. But otherwise, the delay of taking these public pensions can be a significant assistance to you in your later years, with those pensions being larger than would otherwise be the case if you took them earlier. Now, let's move off of the public pensions and talk about employer pensions now. And there's a range of ways that you might be compensated in your employment workplace, where your employer is the primary contributor into the plan for your benefit. We have registered pension plans. So registered pension plans are a little bit less common these days than they might have been a few decades ago. A registered pension plan is one that comes in two main varieties, where with a defined contribution plan, where the known part of the plan is how much the employer will contribute into the plan. And then the money in the plan will be invested. You being the pensioner, you'll make decisions about how that will be invested. So the known part, the defined part, is the contribution in. Then we have defined benefit plans, where the known, or really the calculable part of it, is how much you will take out of it. And that's going to be based on how long you work, the crediting rate that is in the pension agreement. So it may not be directly known by you personally to be able to look at and say, here's how much I can get. But at such time as you say, I'm going to retire on this date, then it can be shown how much you will get on a regular ongoing basis from that point forward. So mainly here, this is the employer making the contributions into the plan. With some of these plans, you can have a combination of you as employee as well as your employer contributing into the plans. Now, we also have hybrid plans where some component is defined contribution, some component is defined benefit, and you'd have actuaries who would be involved with any defined benefit program. Actuaries have to calculate out what the contribution obligation is from the employer. And those types of plans where they have both a defined contribution and a defined benefit provide more flexibility, both for the employer to not be bound by a calculation only, and for the employee to be able to participate in the plan and have two different ways that they might draw down their retirement income. There are also defined profit sharing plans where the obligation on the employer to contribute is based on the profitability of the company. And then there are also group RSPs. So RSPs, which I'll turn to in a second, RSPs are individually owned tax sheltering plans. and they can be grouped up so that an employer can be a contributor into those plans, as well as you or me as the individuals who create and contribute into those plans for our own direct benefit for ourselves. So there's employer pensions, and then turning over to the RRSPs. RSPs, registered retirement savings plans, are accumulation plans. We get the ability to contribute into these plans where we earn income, where we have workplace income. Then we get a, and I'm not going to go through the figures. That's what we talked about on the previous sessions. But they are accumulating plans where there is a maximum that you can put into the plan. So it's a high threshold that you can't go past in terms of your ability to contribute, and that threshold is dictated by the amount of income that you make. That's the accumulation side of things. And then when you look to draw down the money, you then have a few possibilities of how you're going to draw that down. You can take a lump sum withdrawal of some or all of that, but then that means that it's going to be taxed in a single year. And because we have a graduated tax bracket type of income tax system, also referred to as marginal tax brackets, or a progressive tax system where you pay higher rates of tax on higher levels of income, if you take the lump sum all at one point in time, then you're going to push a lot of that RSP accumulation up into high tax bracket. If you don't need that money to spend in that year, you're triggering more taxes than are necessary. And so you would likely be better off, assuming we have a large accumulation in the RSP that would push you up those brackets. You are better off not to take it all at once, and instead to have it over the course of a number of years when you actually have the need for spending out of that money. And the other possibilities then for the money that you've accumulated in your RSP is that you can have it go into a registered retirement income fund, or a RIF, which is as compared to the RSP that has a maximum amount that can go into it for the sake of accumulation. When you move over into a RIF, a registered retirement income fund, then there is a minimum amount that must come out of it, come to you and be taxed to you on a year-to-year basis. And it is based on your age. The percentage goes up a little bit incrementally over the course of your lifetime. You have to take the money that is in your RSP and either take it as withdrawal, fully taxable, or into a RIF, or purchase an annuity, or some combination of these three, no later than December 31st of the year that you turn 71. But you don't have to wait until that point to do this. It's just that is the limiting date that applies. So that other possibility, as I said, is not only that you could have a RIF that you continue to make investment decisions about the invested monies, but you could go to an insurance company and you could purchase an annuity off an insurance company with some portion of that accumulated money that you had in your RSP, and you give the insurance company a lump sum. The insurance company then pays you an annual amount based on the agreement that you have with them. It's usually paid actually monthly, but it would be paid over the course of your life. Then you don't make any more investment decisions at that point. It is based on prevailing interest rates, and that might be an appropriate thing to do for part of your RSP accumulation, and then for another part of it, perhaps you would have RIF money that you would continue to make investment decisions about. So there's your possibilities of what happens with those plans. One of the things to be aware of with RIF payments, just in terms of your requirements as we head into tax filing season now. During the course of your lifetime, you probably had, assuming that you were a straight up employee, if you were owned your own business, then it might be a little bit more complex. But if you were a straight up employee, then on your paychecks, your employer would have withheld some portion of the pay, because they would have to submit that over to the Canada Revenue Agency as part of your eventual annual tax calculation. When you're taking money out of a RIF, you are the one who is drawing that money into your own hands, and you have the possibility that if you don't have tax withheld on the RIF, or you don't have a sufficient amount of tax withheld on the RIF payments, that when you get around to tax filing time, there isn't enough already withheld tax that the Canada Revenue Agency has in its records, and therefore you're going to have to top that up, and sometimes significantly top that up. If that happens, and quite often it will happen in the first year or two that a person retires, then you might be required to pay or quarterly installments of tax rather than being able to just pay everything all by April 30th of the following year. So be aware of that. It might change the way that you're doing your tax filing, and as well, as much as you might say, well, I don't like the idea of the government holding on to my money any sooner than I have it available to me, and so I don't want withholding tax on each RIF payment that I might get. Well, the thing is that if you don't have the withholding happening on a per payment basis, then you may very well have imposed upon you these quarterly installments. So just be aware of that as you're heading into your retirement, that the gross amounts that you draw from your RIF specifically, but all of these sources, they're all taxable. And you are going to have to pay tax come April, whether you pay that on a withdrawal basis, a per withdrawal basis on withholding, or you do it quarterly. You can't wait all the way until the end of the year and only pay it at the very end. Now, some of the things to look at in terms of how you coordinate your household income between spouses, you do have the opportunity to pension income split. What that does is it allows for a person who is receiving qualifying income to have as much as 50% of that pushed over, taxed over to a spouse or common law partner. Okay, so I'll keep saying spouse, but that's a legally married situation, or it could be a common law partner as well. So you, as the person who is entitled to receive those amounts, receive them, and then when you come around to tax filing time, up to 50% of eligible pension income can be pushed over, taxed over to your spouse. And you would do that, of course, in a situation where you've got relatively high tax bracket of higher income and therefore higher tax bracket for the recipient of that pension income, and then lower tax of the one that you want to push over to. Tax software or your tax preparer using their own software will have some kind of optimization feature that would allow for the determination of what might be the appropriate optimal amount to push over. It can be no more than 50%. When you're under the age of 65, the ability to pension split is generally only going to apply with payments out of a registered pension plan, the first one that I was talking about. You also have a kind of unusual situation, not completely unheard of, but an unusual situation where if you are receiving RIF income because you have a predeceased spouse and now you have a new spouse, then that income, it can also be income split with your current spouse. So this is all under the age of 65, so relatively young ages that we're talking about where this would happen. Most often we're talking about registered pension plan. Once you hit age 65, then all of those sources that I'd talked about there, the registered pension plan definitely, and then also RIF income and registered annuity income, those are also able to be income split over with spouse. So you have the income tax then in the hands of the recipient spouse, presumably again lower income spouse, and also it allows for the claiming of the pension credit. The pension credit is a lower tax rate or a tax credit that applies on the first $2,000 of income on the federal basis, and then there's a lesser amount provincially. It saves somewhere, based on the percentage rate, it saves somewhere between, $400 and $600, depending on province, how much you get as a pension credit. So if you are able to do that between two spouses and the recipient spouse doesn't otherwise have pension income to claim the pension credit, so what would happen is not only would you push the household tax brackets or tax effect down by pushing over into the lower income spouse, but also you would access that pension credit, which would give you that extra further benefit. Now, there are other places that that you can save, and it's not necessary that things be called retirement savings to in fact be used as retirement savings. Tax-free savings account particularly is a tax sheltered program, which I would assume everyone, based on your interest in the topic here, would have some familiarity with. It's been around for about 15 years now. With the TFSA, you don't get a tax break when you put the money into it, which is what you do get when you put money into an RSP. And that's why the RSP is effective as a retirement savings tool, because you can take a tax break in your working years when you're at a relatively higher tax bracket level, and then you draw out in your retirement years when you're expected to be a lower income level. So you take a tax break up high, you get taxed on those monies at a lower rate. With the tax-free savings account, there's no tax break on the money going in, but then inside, you get the tax sheltering and there's no tax on the money coming out. Whereas, as I mentioned, whether you take the money as a direct withdrawal from an RSP or you have a RIF payment or a registered annuity payment, all of those are taxable. Whereas the TFSA, no tax on coming out. So it can be a nice complement to your other RSP accumulating pool to work with that other side or that other way to do some of your tax sheltering. You also can have non-registered investments. So these will be ones where you're not going into any of these branded, if you will, tax sheltering plans covered directly under the Income Tax Act. You don't get any direct tax benefits for having accumulated in these plans. It's after-tax money that goes into them, and when they earn income, that income is taxed to you as that income is earned from year to year. If it pays interest or it pays dividends, or you realize capital gains by selling off something that's increased in value, you do pay tax on a yearly basis on the income as it is realized or earned. But you can get preferred treatment. So with capital gains, while the value of the holdings that you have are increasing in value, but you don't sell them off, there's no tax applying. And so you get some significant deferral that can happen until you get the tax applying. And then only half of the capital gain is taxed when you take it out. So you get a lower tax rate on that relative to interest income, which is fully taxable with interest. And then with Canadian dividends from corporations that are housed, are resident here in Canada, when you get dividends from Canadian corporations, you get a lower tax rate on those dividends because those Canadian companies have already paid some tax over to the Canadian government, or the combination of provincial and federal. And so your tax rate as the investor in those Canadian corporations takes into account that there's already been government tax revenue from those Canadian corporations. So you, in effect, pay a lesser amount that tops up the revenue target that the Canada Revenue Agency has for that income, some of which has already been paid by the corporation that then paid you the dividend. If you had a business, going down to the next major point here, if you had a business, then there's a whole variety of ways that you might draw down, sell off your business. That's pretty advanced type stuff here. And so I'm going to defer to your accountant, your lawyer, to have those discussions with you. You've got a lot of possibilities of how you might continue to run the business indirectly, perhaps sell the business over the course of time, a variety of things that you might do. And then last thing that I'll note is with life insurance, when you've done your financial planning, when you've looked at your financial needs and obligations in a variety of ways, whether we're talking about your savings practices, like behavior of saving, your spending practices, your use of credit in a well-informed way, all of those things, and then the sources that you have for drawing down all of the accumulated value that you have. When you project that out in time, you may very well have leftover that is going to be there, even if you live to and beyond your life expectancy. In that case, if you have life insurance, which you had purchased for the purpose of protecting your income earning capacity for the household that you have, is the main purpose that you have life insurance. If you're in a position where there is that excess, then you may want to consider to continue owning that life insurance, even though you would look at it and say, well, if I'm not working, why would I need to have life insurance to replace an income source that doesn't really, I'm not earning income? Well, fair enough in terms of being that direct primary purpose that you set up the insurance in the first place. But now, if there's going to be that excess cash, if you put excess cash into certain types of life insurance policies that are allowed to have over contributions into them beyond the year-to-year premium obligation, then when you put that excess inside of the insurance policy, it can grow on a tax sheltered basis. And then, as life insurance does, it pays out tax-free upon the death of the person. And when it pays out tax-free, then that can add to or support either your surviving spouse or those other family members. Whereas if you don't make use of this insurance policy, if you put it into taxable investments, then the taxes could deplete the amount that you pass on to those people. So life insurance is a pretty complex tax structure that's underlying what otherwise seems pretty simple. You pay a premium, there's a death benefit that eventually comes out of it. Have a good conversation with your insurance advisor, and you can find out more about that. So now, just in terms of where you will be during your retirement years, just a thought. This is well, it's financial related, but it's not getting into those tax sheltering plans that I was just talking about, or those sources. It's just looking at the practicality of where you are and where you're going to be. Quite often, people will assume that they are going to, quote, downsize in their retirement years, and then that is going to be a release of equity value that they then can live on. It's up to you, depending on where you're living and how you want to live, whether you want to rent or you want to own. If you can afford to own, then that might be a good decision. In some places, it might be just fine to continue to rent, even though you might have extra capital to purchase. And then when you sell and why you sell, those may very well contribute into how it is that you then fund your later years. In effect, purchasing a home is like savings, but a very specific type of savings directed towards providing for your future shelter needs with owning a home of some sort. So when you sell off assets, generally, there can be capital gains. So the growth in value from when you purchase something to what you sell it for, that's a capital gain. But in the case of your principal residence, you're able to protect your principal residence from being taxed under the principal residence exemption. There's some nuances involved with how it applies, so I won't get into all the complications if you had multiple properties, but generally, if you are living in a property that is your principal residence and you sell it, you're not going to be taxed on the capital gain. So that's something where you might look at that and say, oh, well, then good. I can probably use that in some way towards my my income needs in my later years as I downsize. I'll sell that and I'll move to a smaller place. But the question becomes, well, if you're going to downsize, where are you going when you downsize? Are you going to go from one property over into another one that is smaller, less stairs, let's say, or something that is more accessible if you have some kind of mobility needs or just other supports that are required? Is it that you don't want to have to maintain outdoor property, doing the lawn, shoveling the snow, and so going into an apartment building might be something that would relieve you from those things? Think about the practicality without necessarily going into deep investigation right away, but think about the practicality of when you are moving, are you actually moving into an entirely new type of location? Or are you staying within the same geographic market, which means that the likelihood is that if prices are up, where you are, and you're going to sell something that is larger, you're going to be acquiring something in a similar market if you're not going to move too far, that also prices are up. So you're not necessarily going to harvest out the full difference between the apparent value of where you live and where you're moving into once you take into consideration transactional costs, real estate commission, land transfer tax, moving costs, new furniture of some sort, appliances. All of those things pretty easily can get up to 10% or more of the difference from what you thought you were going to realize and where you go to. So you might be making more of a lateral move in some cases rather than being outright downsizing so that you can harvest out a significant amount of the capital that you have invested in the place where you own. So think through, do the deeper analysis as you get closer to that point and make that decision. Be careful about assuming that the place where you live will be a significant source of the income that you will have. You're always going to need to live somewhere, so you're not going to be able to completely liquidate it. You're going to need that value to then pay future rent if you're not going to own anymore. So just be careful about how you go about doing that. It certainly is possible to do, but it needs a little bit deeper analysis and making sure that you know where you're going to end up. This chart here, this is not a spreadsheet. Well, it was made using a spreadsheet, but it's just to show the distinctions among the types of sources of income that you might have. And these are not the only sources of income, as I was taking you through: work savings, public pensions, private sources, and real estate. These aren't the only sources, but they're the main types of sources that you might have. What this is for is not to say, well, then plug in a whole bunch of numbers to try to figure out how much you're going to have at different ages. The idea here is to look at what you have as income sources and determine when you expect that you're going to draw on these, when you're going to start your old age security, when you're going to start your Canada pension plan, when you expect you're going to sell certain property, when you expect that you're going to wind down a business if you own a business. And it's just the idea of these being the sources of the places that you're going to draw income from, and then have a conversation with your financial advisor about what these values will be. I gave you some of the CPP and the OAS numbers. Your accumulation in a registered pension plan entitlement, RSP, RIF, those types of things are specific to you. There you can look at not only the check mark as to which years you would draw from what places, but also then how much you would get into. But this is just the idea of checking the boxes and saying, well, where's the money going to come from these different places, particularly when you sell off extra real estate, not your principal residence. That is going to be a big lump sum that's going to happen at one point in time. It's also potentially going to be a tax bill that would associate with that, because when you sell something, you have a capital gain. If it's not a principal residence, then you're going to end up with a tax on some portion of that money. And so be prepared that the event itself will be good in terms of harvesting out the net cash, but combined with having to pay a tax bill on that. Along with that, the idea that some people have is, what is the ideal way to draw down my retirement income? And it's quite often based on, or it has as its underlying premise that there is an optimal way that you can draw down from the savings that you have. Now, I just showed you a whole bunch of places that you might have as income sources. Again, OAS and CPP from the public pensions. You'll have your registered money of retirement savings, either entirely in RSPs initially before you turn them into payout type arrangements like a RIF or an annuity. You've got your tax-free savings accounts, you got non-registered money. So there's a whole bunch of places where these things might happen. And I like to use this just to show how complicated it might be to go back to the game of chess. Whether you're familiar with chess or not, it's basically a grid. It's an 8x8 grid. There's 16 blocks or spaces on the board, or 64 spaces on the board. Each of the players has 16 moving pieces, and you go back and forth between the two of you. On the first move of the first player, which is the player in white, there are 20 possible moves that can be made. After each of them have moved once, there's 400 different permutations of what the board might look like. After they've gone 3 times, we're up to almost 200,000. And once they've gone 4 times, then we've got 120 million, roughly, of permutations of the board. Well, that's with a 64 box grid that we're looking at. If you're talking about how you draw down money out of your retirement accumulations, it's much more complex than that. So don't get stuck on this idea that there is one optimal way to draw down the funds that you have. It depends on your circumstance, and it depends on your changing circumstance. So when you will look at it at the start and say, what is the best drawdown that I can take on a current basis so that I don't trigger any more taxes than I really have to, but I also don't put myself behind a tax problem somewhere out in the future as well. And then on an annual basis, you come back and you review according to what's happened with the wealth sources you have, what's happened with your situation, your family, your needs, and then the broader economy and the changing world. And then the last thing that I'll touch on here is just an idea of how you spend your time in your retirement. I look at what is your purpose of how you spend your time. Again, when you're younger, you think, my purpose is going to be lying on the beach. It's going to be wonderful. I have one of my close friends who sold his business and retired at 43 and went golfing, and about 6 months later was so bored that he went back and he worked for the person he sold the business to because he couldn't stand just hanging out on his own at 43 golfing all the time. So what's your purpose? So this is just a suggestion of how you might look at how you spend your time now as a way of thinking of how you might spend your time later. So this, it's not an acronym, but I call it Decumulation. So things that you do on a daily, weekly, monthly, seasonal, and annual basis, and then how that might change as you go into your later years. So when you retire, how might you upsize some of these things? How might you downsize some of these things? How might you change some of the forms of what you do? You can just do this by taking a piece of paper and one of those old pencil thingies and draw lines down it and just write in the things that you familiarly do on that time frame and how you expect that's going to change. And you can make it more complex if you want, but just generally, it'll give you a picture of what you might do in your retirement years. You may very well change things up for the first few years significantly when you go into retirement, but most people settle into a routine that looks similar to what they have done in the past during their working years, but with more flexibility if they saved appropriately and if they draw down in a tax-informed way. So I'm going to let Amanda jump back in here and see if there are any questions, and I will turn it over to you.
Thanks so much, Doug. So I'll open the floor. There's no questions in the chat right now, but if there's anybody out there that has any questions, please feel free to ask away or pop them in the chat. And while we wait, Doug, maybe I'll ask you a question.
Sure.
So should the RSPs be drawn down to the maximum amount to minimize the 50% plus tax the estate would have to pay?
When you're drawing down your RSP, this is my principle about doing this, and I know that people like the idea that there can be an optimal. That's what I was just saying. There can be an optimal number involved. My approach to it is that with tax planning, generally what you're trying to do is use whatever preferred income that you can, lower tax rate to a particular type of income. But otherwise, the main thing that you can do to reduce taxes is to income split. You can do that through that, for example, that pension splitting. You can do that. You can also do that with yourself by just using RSPs, for example. You income split with your future self by not spending in a working year that then you push out into your later years. Similarly, when you're in those later years and you're drawing down off of your accumulated wealth, particularly the taxable stuff, the RSP sourced money, then when you're drawing off on that, ideally what you want to do, and I know this sounds simple, but it's not, but it gives you a target, is to draw down enough income on a current year basis so that you pay an amount of tax which is equal to what you expect you will pay over the future years of the remaining assets that you have. And of course, you don't know how long you're going to live. You don't know what's going to happen with those investments. You want them to earn 25%, but they won't necessarily. And so you'll revisit that. But that's the idea, I think, as a principle you want to look at, is trying to equalize your current year self with all your expected remaining years, and that'll reduce down the taxes that you eventually will have to be paying.
Great. Thank you. We got a few questions in the chat here, so I'll start off with Ross. Thanks, Ross. Can a Canadian make voluntary payments to CPP to buy incremental eligible years? This is possible in the UK. So the scenario is non-Canadian tax residents making RIF withdrawals. Are there any ways to avoid or reduce withholding tax 15% plus levied by CRA?
I'm not aware on the first question, and I'm not quite following the second one. So, then that's very personal specific, obviously, and it's not unique to one person, but it is definitely a circumstance where you've got non-Canadian elements that are involved there. But no, I'm not aware that you can buy incremental years on the CPP.
Question from Glennis is the true figure for comfortable retirement now 1.75 million?
There is no true figure of any sort that I'm aware of. What you want to do is you want to make sure that you have a sufficient pool from all those sources that is going to pay you the amount of income per year for your remaining life. It just depends on what kind of lifestyle you have and what kind of income you'll have off of the investments, as well as your drawdown from those investments. So I don't get stuck on that idea. If I always told you that there is a number, there isn't. There's no such thing as a number. It depends on what your income needs are, what your expenses are, and what your assets, your existing assets are, separate from your investment assets. So do a deeper analysis, or have your advisor sit with you and help out to do a deeper analysis rather than just having a target figure.
Raleigh has asked, is there any app that I can customize my preference regarding my retirement plan so that I can pick which fund is better for me to get?
I'll defer to your advisor as far as any investment recommendations, whether that's stocks, bonds, GICs, funds, whatever it might be. I'm not I'm not licensed, and we're not talking about individual choices directly here. But as far as the financial planning of what accumulation you need to get, there is, and I think we may have shared this, but if not, the Financial Consumer Agency of Canada, FCAC, if you go onto the canada.ca website and search FCAC, there is a retirement planner that's in there. There's commercially available retirement planners. There are financial advisors who will sit with you and help you out with figuring this directly, and they'll have software available to them. But if you want one that is not a commercially driven type of plan, then go on to the FCAC or the Canada.ca and check the FCAC and see what the software is there that will give you. It's a pretty good tool. I used to use it myself to verify against my crazy spreadsheet that I keep, and I think that it's worth taking a look at.
Okay, last question in the chat from Ross. Are there any software providers or technology platforms that model asset decumulation scenarios in a situation with asset income expense in more than one tax jurisdiction, example, Canada plus another country?
I know that there are commercial software providers who will offer themselves out to do that kind of thing. And I would just, again, I would seriously caution you about the output that you get from any of that software. Arithmetically, it might be just fine, and I assume it would be before they would stick their necks out and put software on the market. So arithmetically, sure, it might come up with a figure of what might be the result based on the assumptions. But like my chess example there, the assumptions are very, there are numerous assumptions, and there are many ways that those assumptions can be applied, and they don't easily fit into a spreadsheet. I love spreadsheets. I got crazy spreadsheets, but be very careful about software that says this is it and you never have to revisit it. It's going to be based on the assumptions. And if you can't draw the line between the assumptions as being reasonable and the outcomes that you have, then it could be misleading if you're not careful. So just be very careful. But there's lots of software that again, software providers that will offer those kinds of analysis to you.
That brings us to the end of the questions in the chat. So thank you all for the questions that you asked. And Doug, of course, thank you for hosting for us today, and all of our attendees for coming. So just a couple quick things here before we wrap up. You will receive an email from myself, including a survey asking for your feedback on the event in the next day or two. If you also gave us your consent when registering, you'll receive an email from an advisor with some handouts about the information shared today. If you didn't give us consent but would like to receive the handouts, just let us know in the chat and we'll be sure to add you to the list as well. If you do have any questions or would like to start the next steps in planning for your retirement, you can reach out to either your financial advisor or our member contact center, and you can see the number here on the closing screen. And again, thank you so much for joining us, and I hope everyone has a wonderful day.